Hello everyone, welcome to today's US Open Live webinar, the first of the new month. It is Tuesday, April 4th, 13:20 GMT, 10 minutes before Wall Street opens as always. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. So last week lacked major events and was a bit dull, I could say, but the current one started with a bang. Saudi Arabia and other OPEC members said they will slash production in a surprise move. Today, the Reserve Bank of Australia paused its tightening cycle after 10 consecutive rate hikes, while Tesla over the weekend reported its quarterly delivery figures. So that these are some of the things and developments we will be discussing in today's US Open. But before we begin, as always, please read carefully through the disclaimers and the risk warnings. Once again, please read carefully the disclaimers and the risk warnings, and as always, bear in mind that anything discussed during this session does not constitute investment advice, and it should not be construed as such. Okay, let's get the ball rolling. We have quite a few things to cover. As we said, it's been an eventful start to the month and the week. We have the Aussie versus the US dollar in the background. And before we go over that, let us say that a few things about Tesla. They began reported record deliveries for the first quarter. Over the weekend, quarterly growth was relatively small, but still record figures, while production growth was marginal. And once again, there was a sizable gap between production and deliveries, despite price cuts. Markets did not like very much these figures, and Tesla dropped around 6% yesterday after those figures. Of course, we will have the chance to talk more about Tesla over the following weeks as the new earnings season is right around the corner. Let's start with today's session with the Aussie, the Australian dollar, and the RBA hold before we move on to the decision by the petroleum exporting countries. Now, the Central Bank of Australia kept rates unchanged after an 11-month tightening cycle and 350 basis points worth of hikes in 10 consecutive meetings. Now, the move was hardly a surprise as it had already softened its stance recently, and we knew that policymakers had agreed to consider a pause this time around. The RBA, however, did not shut the door to more moves, saying that some further tightening of monetary policy may well be needed. Now, the pair had rallied yesterday. You can see this surge here as commodity currencies benefited from the spike in oil prices. We will talk about that in a little bit. But it was stopped here by the 38% Fibonacci of this year's drop, and drops today after the RBA hold. Now, below that level, there is scope for further pressure to meet 0.66 around here, and there is definitely potential for further for new 2023 lows at around 0.6563, but definitely a fresh catalyst would be required for such moves. Now, on the other hand, the Aussie tries to find some support around the 200 period DMA, as you can see now, above which immediate bias on the upside, and will give the pair the chance to try again for the 38.2% Fibonacci we discussed, but we can see that the upside appears to be well protected. Now we can see that the Aussie had taken advantage of the, let's say, more conservative stance by the Fed recently due to the banking turmoil, as we have discussed several times on our US Open sessions. But now the ECB already paused, while the Fed has at least one more hike, at least based on the stated intentions and market expectations, before it pauses its tightening cycle. So this theme definitely caps any potential upside for the, or let me rephrase that, this differential now does not leave much room for moves higher. Of course, there are other things in play, and we'll need to see how the policy landscape shapes up over the following weeks and until the next rate decision by the Fed. So that's it for the Aussie. Let's now move to Euro USD. Which clinches new highs. You can see here, marginally so, but it does. But on the other hand, the relative strength index, you can see here, does not follow higher, which make up the upside. On Friday, Eurozone headline CPI preliminary figures showed significant moderation, but the new oil production cuts may put a different spin on that, while core ticked up. From a technical perspective, little has changed. The road to 1.1067 and new 2023 highs remains open, but we are cautious about further strength. We still see the policy differential between the two central banks as favoring the Euro USD, but we struggle to see some big move at this stage. Of course, there are other events coming up that could spark any big moves either side. Now, given the fact that the progress is slow, there is risk of a slide back to the 200 period DMA at around 1.075, but a catalyst would be needed for daily closes below it. And as we have said, given the current environment, we struggle to see sustained weakness past this broader, that would actually test and past this broader region here above 1.05 or around 1.05. And now let's shift gears and go to US oil to discuss the surprise move by the OPEC countries on Sunday. Let's bring US oil on our screens. Here we are, that's the 4-hour chart. So what happened on Sunday is that Saudi Arabia and other countries announced production cuts of over 1 million barrels per day, which will begin next month and last until the end of the year. Now remember that Russia has already slashed output by 500,000 barrels and also said that it will extend that until the end of 2023. And all of that is on top of the already agreed output reduction plan of 2 million barrels per day that had been agreed back in October. So overall cuts from May, planned cuts, let's say from May until the end of the year, are well in excess of 3.6 million, and this is likely to cause tight supply. Already there were prospects for tight supply on the back half of the year, and the International Energy Association actually said that we already were going to have tighter markets, and this may put further strain. Now, of course, as a result, US oil rallied. It actually gapped higher on Monday, rallied more than 6%, and now tries to set new 2023 highs, which will bring the 90.36 resistance in the spotlight. However, you can see that the relative strength index down here is at the most overbought level since October, and this can way back towards the 200 period EMA at around 74.5. However, these cuts I think can again now contain any more significant decline in oil prices. And remember, we also have China's reopening. We have prospects for more conservative prospects for more, or at least hopes for more conservative central bank stance. So overall, I think that it's hard to see sustained weakness below the 200 period EMA and definitely below the 70 line, which have been breached last month, have given way actually. So that's pretty much it for US oil. Now let's go to the Nasdaq, as we are already 2 minutes into the US session. Of course, the decision by oil producing countries could actually push inflation upwards, and that could have ramifications for monetary policy. Now, NAS 100 comes from a strong first quarter despite the backing rout, partly due to the more conservative approach by the Fed, as we said. Friday's PC inflation did not create any pressure for a more aggressive stance, as it eased marginally, but it did. But again, the oil output may complicate that. Of course, the next test for the Fed's new approach will come from the jobs report on Friday. The tech-heavy index sets new 2023 highs today, trying to exit the bear market, and now eyes 13,724. A correction though may be required for that. As such, we can see a return below 12,900. That would seem reasonable, but a strong catalyst will be needed for a breach of the 200 period EMA, and the downside is definitely well protected. So before we conclude, let's take a look at what's ahead. The Reserve Bank of New Zealand takes up the baton from its Australian counterpart, although a similar outcome it would be a surprise, at least based on baseline projection and RBNZ commentary. The Central Bank of New Zealand has been hiking rates since October 2021, has not shown any inclination to back down, although a slowdown could be in play. The last hike was of 50 basis points. Baseline projection now points to a 0.25 percentage hike, a smaller move that is. And that's, of course, the decision is due in a few hours, essentially at the beginning of Wednesday. Other than that, later on Wednesday, we expect another round of PMIs, while today at the top of the hour, in less than 30 minutes. US factory orders are due. Other than that, we also have some holidays coming up in Europe and US, and of course China over the coming days. And that pretty much wraps things up for today. We will have our next session as always on Thursday, same time, 10 minutes before Wall Street opens. Thank you for joining me.